Every time the economy starts to crack, millions of people panic. They pull their money out. They sell their assets. They wait on the sidelines, paralyzed by fear. And then, when the storm passes, they watch helplessly as the market climbs back to new heights, without them. But here's the truth that most people never learn. Recessions don't just destroy wealth. For the right investor, they build it. The difference between those who lose and those who win isn't luck. It's how they think. This video is about exactly that, the mindset, the strategies, and the habits that separate smart investors from the crowd when the economy starts to fall apart. The mindset shift that changes everything. When a recession hits, the first thing most people do is react emotionally. Fear takes over, news headlines spiral, portfolios shrink, and in that panic, ordinary investors make the most costly mistake of all: they sell. Smart investors do the opposite. They understand something fundamental: recessions are not accidents. They are a natural, predictable part of the economic cycle. History has confirmed this time and time again. After every single economic contraction, the Great Depression, the dot-com crash of 2000, the 2008 financial crisis, and the COVID-19 shock of 2020, the market has recovered.
18, you mentioned that you guarantee you could make a 50% annual return if you had to start again with under $1 million.
Not once has it failed to bounce back. Warren Buffett, the chairman and CEO of Berkshire Hathaway and one of the most successful investors in history, built much of his fortune precisely by thinking differently during downturns. His philosophy is deceptively simple. When others are fearful, he gets greedy. When others are greedy, he gets fearful. During the 2008 financial crisis, while most investors were fleeing the market in terror, Buffett was pouring billions of dollars into undervalued companies. He understood that falling prices were not a threat, they were a sale. This mindset shift is the foundation of everything. A recession doesn't mean that good businesses have stopped being good. It means their prices have dropped temporarily. Smart investors see that clearly. They don't let short-term noise shake their long-term conviction. What makes this so difficult for most people is that panic feels rational during a downturn. When every headline screams that the economy is collapsing and every portfolio graph is pointing downward, doing nothing, or worse, buying more, feels reckless. But the investors who consistently win are the ones who have trained themselves to separate emotion from decision-making. Ray Dalio, founder of Bridgewater Associates, the world's largest hedge fund, has spoken extensively about understanding economic cycles. He famously predicted the 2008 financial crisis and repositioned while peers suffered massive losses. His edge wasn't just intelligence, it was preparation and emotional discipline. He had studied history, understood cycles, and refused to let fear dictate his strategy. The first step to thinking like a smart investor during a recession is accepting that downturns are not exceptions. They are part of the game. Expecting them, planning for them, and staying calm inside them is not naive. It is the most powerful competitive advantage an investor can have. The strategies that protect and grow wealth. Once the right mindset is in place, smart investors act with purpose. They don't make wild bets, and they don't freeze entirely. They make deliberate, well-reasoned moves designed to protect what they have while positioning for what's coming. The first strategy is diversification. During a recession, not all assets fall equally. Bonds tend to move in the opposite direction of stocks. Gold has historically risen when markets fall. Real estate, particularly properties in essential locations, continues generating rental income even when broader economic conditions weaken. Smart investors spread their exposure across these different asset classes so that a crash in one area doesn't wipe out everything.
With that, democracy system ceased to exist. So that dynamic.
On exactly this principle, his model balances long-term bonds, intermediate bonds, stocks, gold, and commodities in proportions designed to perform across different economic environments. Historically tested, this portfolio has generated positive returns roughly 85% of the time. Even during the Great Depression, when the S&P 500 lost around 65% of its value, a portfolio structured this way would have lost far less. The goal is balance, not trying to predict what will happen, but ensuring that whatever does happen, the portfolio survives and ideally benefits. The second strategy is focusing on quality. When markets drop, The prices of both strong companies and weak ones fall together, but they don't recover together. Strong businesses with low debt, consistent cash flow, reliable earnings, and dominant market positions tend to bounce back faster and reach new highs. Weak companies often don't survive at all. Smart investors use a recession as a screening tool, buying shares in fundamentally excellent businesses at prices that would never be available during a bull market. Dividend-paying stocks deserve special mention here. Companies with a long, consistent history of paying dividends to shareholders, even during hard times, signal financial strength. They keep paying investors while everyone waits for the recovery. These are not flashy bets. They are steady, income-generating positions that provide cash flow regardless of what the broader market is doing. The third strategy is dollar-cost averaging. Instead of trying to time the market, which financial experts widely agree is nearly impossible to do consistently, smart investors keep putting money in at regular intervals. They buy during the dip, during the middle of the decline, and on the way back up. Over time, this approach lowers their average cost per share and maximizes the benefit of the eventual recovery. Missing the rebound is just as damaging as participating in the crash. Staying invested, even imperfectly, beats sitting on the sidelines. Warren Buffett has advised most ordinary investors to keep it even simpler. Own a low-cost S&P 500 index fund and keep contributing. Broad, consistent market exposure over time has outperformed the majority of active investors across decades. The point is not to be clever. The point is to be patient, consistent, and grounded in quality. The habits that set smart investors apart for life. Strategy alone isn't enough. Smart investors during a recession operate with a specific set of habits that most people overlook entirely. These habits are what turn a decent strategy into exceptional long-term results. The first habit is maintaining liquidity. Smart investors always keep a reserve of cash or cash equivalents available, typically enough to cover 3 to 6 months of living expenses at a minimum. This reserve serves two purposes. First, it prevents forced selling. If an investor is living paycheck to paycheck, a personal financial emergency during a recession could force them to liquidate investments at exactly the worst moment when prices are at their lowest. Second, liquidity creates opportunity. Recessions produce rare buying windows. An investor with cash on hand can move quickly when exceptional assets become available at depressed prices. Buffett himself has emphasized keeping significant cash reserves before and during economic downturns precisely for this reason. The second habit is long-term thinking. Recessions feel permanent when someone is inside them, but they are, by definition, temporary. The average recession in US history has lasted less than a year. The recoveries that follow tend to be far longer and far more powerful than the downturns themselves. Smart investors anchor themselves to a timeline that stretches years or even decades ahead. They are not trying to profit next quarter. They are building wealth over a lifetime. That perspective makes every short-term decline smaller and every recovery more rewarding. The third habit is continuous learning. Downturns are not just financial events, they are educational ones. Every recession teaches investors something new about markets, psychology, monetary policy, and their own risk tolerance. Smart investors study history, they read about past crises, they analyze what worked, what failed, and why. This knowledge becomes armor. The investor who has studied the 2008 financial crisis is not surprised when another shock arrives. They know recessions end, they know recoveries follow, and they know that the most dangerous thing they can do is react with fear. The fourth habit is resisting the noise. During a recession, media coverage intensifies. Predictions become louder and more extreme. Social media amplifies every scary data point and doomsday scenario. Smart investors learn to filter this aggressively. They focus on fundamentals, valuations, cash flows, balance sheets, long-term prospects. They tune out the noise and act on data, not drama. The investors who emerge from recessions stronger are not the ones who predicted every move correctly. They are the ones who stayed disciplined when discipline was hardest. They held quality assets when everyone else was selling. They kept contributing when headlines told them to stop. They maintained their strategy when panic said to abandon it. Every recession in history has eventually given way to growth. Every market low has eventually been surpassed by a new high. The smart investor understands this not as optimism, but as studied historical fact. The question is never whether the economy will recover. It always has. The question is whether an investor will still be positioned to benefit when it does. And that answer comes down entirely to how they think.